This is an example of a cash budget. Now, you've addressed cash flow in looking at the accounts of companies. The three main statements are the balance sheet, the statement of financial position as you know it, the income statement, and a cash flow statement. I have to say that in practice, most companies, if they're happy that their sales are going to turn into cash, that they've managed that part, they don't worry too much about the cash flow. One of the reasons you see it in textbooks is simply that a lot of the economic models in finance are based on cash flow, and essentially it was an accounting an academic influence on practice that made companies report cash flow statements in addition to the statement of financial position and income statements. So it's important in our economic models. In practice, it's not so important, and I know of no serious difference between profit and loss accounts and cash flow statements for major companies. Major companies, on the whole, do not suffer from cash flow problems. However, it is something that companies would look at simply to ensure that they don't run out of cash. Sales are seasonal and there are going to be quiet periods, and they may need to borrow money in quiet periods. Okay, so we've got our cash flow statement. Basically, the blue numbers are money in, the red numbers are money out, the green numbers are the difference between money in and money out. So 60 minus 42 is 18. And then we have the balance on our cash account, that's our bank account in essence. Opening balance given as 12 plus 18 gives us our closing balance, which is the opening balance of the following month, and so it goes on from month to month. So that's the overall structure, and the two main figures that you may not be too familiar with are the receivables and the payables. The receivables come from sales, which revenue that you know from your income statement, and the payables come from purchases, which you also know from your income statement. How do we work these out? Well, for the receivables, we have the sales revenue, which you're familiar with. That's from the income statement, and it's when these sales turn themselves into cash. In this example, we've assumed that it's 1 month later. In practice, it might be half a month later, or half in the month, half a month later, or 2 months later. So it could be a range of patterns that the firm might want to look at. But in this example, everything is going to be, according to the budget, paid 1 month later. So their sales of 55 in February are going to be paid in March. The 60 in April paid in May. So that's the actual cash receipt. And these are the figures, these are the blue figures, all these are the blue figures that we have here: 60, 52, 55, 60, 52, 55, and so on. So that is all, that's our cash inflow, if you like. This is the opening, is less important, it's just the balance on the cash inflows, but this line is the one we want to use for our cash flow budgeting. Then for our purchases, this you'll be recognize this from the income statement. we want to know when we're actually going to pay, and here we plan to pay also a month later, which is all nice and convenient. So we agree to pay a month later, so we've got our cash payments, which are the payables line here. So 30, 30, 31, 26 and 35 come out here, right? 35 and 31. So that's how we get our cash payments. We look at our purchases, we then make an assumption about when we're going to pay. We're going to pay a month later. So we can go back to our statement here. Excuse me. We have got our payables here, we've got our receivables, all these other costs we assume are going to be paid in the month. We total it all up, 30 plus 10 plus 2 is 42. We take the 42 from the 52 and gives us our balance of 10. So 18 surplus in the first 2 months of 18 and 10, then a deficit, then surpluses. Our opening balance given to us is 12, plus the 18 is 30. That's then the opening balance the following month, plus 10 is 40. Then opening balance for March is 40, less the 13, 27, and so on. And that is our cash budget. So it'd be looking to our cash budget to make sure that we don't go too heavily into overdraft or go over any limit agreed by the bank. But it's quite normal for businesses to have an overdraft. It's a kind of funding from the bank, but it can be quite expensive. It's much cheaper to be in debt to creditors who don't charge you any interest, or maybe to bondholders who have a lower interest rate. The bank is an expensive form of borrowing, so they want to avoid that, and one way is to look at the cash budget and make sure that you don't go too far into overdraft. Here they're in surplus, so that's slightly unrealistic, but nevertheless that's fine. The final bit of the budget, budgeting by month that we want to look at are where the purchases go. We've got the purchases here of 30, 31, 26 and so on, and that comes from our trade payables budget or our income statement, whichever. It should be the same. These are what we purchased, not when we paid. We paid all these a month later. But we want to have a look at our stock month by month to make sure that we don't run out of stock and that our purchases are adequate. And this we do with our opening balance plus our purchases less the stock used or inventory used, and that gives us our closing balance. So if this went down to a very low figure, then perhaps our purchases would not be sufficient. We'd need to buy more stock in order to fund the sales. So generally in the budgeting exercise, you start with sales, you then work out what purchases you need to support those sales. You then look at the cash flow position when the sales are going to pay. That kind of dictates when you're going to pay your creditors, and you work out your purchases by making sure that your stock doesn't fall too low. Your purchase pattern is not going to be the same as your sales pattern, so your stock levels might go up during a slack period where you're buying in regularly, producing at a regular rate, and your stock level might go down during busy periods where your production level is still constant, but more is going out the door, so the stock levels go down. So you don't want that to get too low and to make sure that your stock doesn't get too low, you would carry out an inventory budget. So there we are. We have the income statement translated into a cash flow statement, and checking on the purchases by having an inventory budget to support your cash flow budget.